Hey everybody, I see people clicking in. Welcome to Rose City Rollers Online. We are here with Kernel, Wrecker for Life, probably know her, from the Hangar, and then Jennifer Leon joins us from Bank. Kernel is a CPA and has her own practice here in town. I will put that information in the chat, or you can grab it on the Facebook link or on our website. They're going to talk us through some common tax questions and some information that's relevant to this time and space in our lives as we're all sitting at home with our thoughts a little bit too much. This is great conversation to be able to have in real time if you have questions. We will have a Q&A open. You can see it at the bottom of your screen when you toggle around at the bottom. And you are welcome to chat. In the chat, I will feed that to Kernel as well. But if you have specific questions about what they're chatting, what they are talking about at this moment, put those in the Q&A so I can make sure that those get addressed first, and I'll try to monitor the chat as well. But any questions that are more overarching or about something that's not covered specifically in the presentation, I'll hold those till the end so we can let them get through all of the relevant content that they have. So with that, I will turn it over to Kernel and Jennifer. Take it away.
Thank you. Hello, everyone. I'm assuming there are hundreds of you watching. I can't tell.
There are 7 whole people so far.
Yeah. My team is trying to Snapchat audio call me. Hi, everyone. Okay. Thank you for coming to my tax talk. And today I wanted to just talk about some things related to taxes that I thought were just relevant right now. And just to let you know, so accountants end up, I'm a tax accountant, and I really just prepare tax returns, which is, yes, a full-time and year-round job. And because of being associated with the business world and, financial stuff, I know a lot of things. Maybe I know a little about a lot of things. I know a lot about taxes. And then I know about other stuff like IRAs and mortgages and things like that. So what I'm going to focus on right now today is really how some different income items and other things affect your taxes or should look on your taxes. And then I invited Jennifer to talk about mortgage stuff as it relates, just some information that she has. And then when you're self-employed, what your tax returns should look like to get a mortgage. And I know that a lot of people in RCR are self-employed. Some other people have a lot of different jobs. Some people do, a lot of different gig jobs. Some people have a main, they're a massage person or what have you. And so I just thought that was like a good topic. And Jennifer and I did a presentation at her bank in February, right before the shutdown. So the first thing that I wanted to talk about is the stimulus checks. So I'm hoping everyone has gotten their stimulus checks. Mine came by mail because I don't have direct deposit with the IRS for various reasons, and not because I'm afraid of the government, but just because. And so I'm hoping everyone got their check. And I know if people haven't filed in 2018 or 2019, you probably would not have gotten that check. The IRS would not have sent that to you. So my first thing that I wanted to answer is this taxable income? Most people got $1,200, which is a lot of money. And lucky for us, it is not taxable income. It is, and you do not have to repay it. It is not a loan. And so what it is it's a tax credit that we have been given in advance. So it's a 2020 tax credit, and we got it in 2020, but we didn't have to do our tax returns in order to get it. And then some people maybe 2018 and 2019 were big income years for you and you didn't get the full 1,200, then in 2020 on your tax return, there'll be some sort of calculation, and you will get the rest if your income has gone down, which, you know, many people, obviously their income has gone down. And so also for that, there is a website. So I know some people, not a lot of people, prefer not to file tax returns because they make their income maybe under the table or through barter, things like that. There is a place where you can go and put your information in if you're what's called a non-filer. But if you plan to file 2018, 2019, and you're just late, do not use that website to put your information in. It will cause your tax returns to be rejected. So then the next thing is, I know that a lot of people are getting unemployment right now. And then that is also a question, is unemployment taxable? And yes, it is, unfortunately. If you made the choice not to do withholdings, you may want to rethink that. It will add up depending how long you're on unemployment. And, you know, it may be too late depending on when you started getting it and what's happening now, but it will add up, especially because of the extra $600 payment. And, you know, it's not good to be caught at the end owing tax. So if you feel like you're worried about that, or you start to be worried about that, a person like a tax preparer or CPA can help you with tax planning, and you can make payments. You can make payments during the year if you feel like you might get caught in the end not having paid in enough tax on unemployment. And the thing about that too, there's some bad information online saying that Oregon does not tax unemployment, and they do tax unemployment. Back in 2009, I've been through a couple of these, I'm sure Jennifer you have as well, different recessions and different things that have happened that have affected our economy and our employment. And so back in 2009, I believe it was only Oregon, they made a certain amount of your unemployment non-taxable. I think it was $2,400. So it's very early in the year to know how that stuff is going to play out. If so many things that are taxable now may become not taxable, depending on what the Congress does and what our state legislature does. So the information I have is as of right now. Should I answer this question from Jump Cut?
Yes, I was just going to come in when you had a little pause. So
okay.
when the question is for everyone, when you say that the stimulus is a tax credit, do you mean on top of other credits? Will it change our 2020 tax return at all?
I do not think so. If you received $1,200, then there'll probably be some sort of form. There used to be, if there was a form called a Making Work Pay form for a stimulus that we got back a while ago, a long time ago. Probably something like that to compare your income and see if you got the full 1,200, and if not, to give you the difference. And it will probably not change anyone's tax return. I don't know. I mean, I'm sorry, but it's May, and like so much has happened in the last 2 months that, you know, I don't think so. That's my answer for right now. Okay, then the next thing, so unemployment, yes, taxable. What else is taxable? This is just an aside of other things that could happen, or income that you could get. So debt cancellation. So if you have a credit card debt canceled, that is income. It's called debt cancellation income. If you end up having part of your mortgage canceled, or back in the, also the way back times, when people were really underwater with their mortgages, they would, be foreclosed on. They couldn't sell their house in time. They would have their mortgage debt forgiven. Forgiven means you don't have to pay it. It does not mean that it is not income to you. So debt cancellation is income. Legal settlements. If your granny gives you stock and tells you you can sell it for money, there will be income on the gain of that stock, which is the difference between what was paid for it and what it's sold for. Investment income, I have clients say, well, I just put $100 into something and then it just made $10. Well, that $10 is just taxable. So always give your preparer all the forms. And then if you get a 1099 miscellaneous, or you think you should have, that income is probably taxable. And then Jasmine made this PowerPoint for me, little text, made this PowerPoint for me. And we actually had like a little disagreement about whether or not reimbursements from RCR are taxable, because they do ask you for a W-9 when you get that check or when they pay you. And for the most part, they are not taxable. If I bought some snacks for the refs for a game, and then I submit that for reimbursement, that is not taxable to me. It sounds like when officials get reimbursed or get a stipend for travel, that does become taxable. So that just depends. As always, as we say in tax, it depends.
Yeah, if you're 1099, I used to do a lot of 1099 work, and you have the receipts for that. People will often combine it, right, Kernel? So they'll combine your work 1099 income with your reimbursements, which is always a little foggy to sort out. But as long as you have the receipts for the reimbursements, you can subtract that from the, quote unquote income portion.
Yeah, you can. And that's actually, okay. So I'm going to go back because I just looked at my notes. Jennifer and I had talked about, and this is, she's not a lender, she's a mortgage broker, right?
A mortgage broker and a lender, yes.
Yeah, so, and a lender. And so I had said, can you let people know what it means to have their mortgage deferred or forbearance? So I wanted to just go back to that debt cancellation or that kind of stuff. And can you talk a little bit about what that means for people?
Well, debt cancellation to me means short sale. So that means I put my house on the market and waited for the bank to approve the sales agreement, and it's shorter in terms of the sales price versus what I owe. So an example would be I listed my house for $200,000, but I owe $300,000 on it. And the bank agrees to the shortfall, which basically is the debt cancellation piece. That doesn't have anything to do with forbearance. Forbearance is really just deferring the mortgage payments, and it depends on who the servicer of that loan is. Some lenders like Umpqua, for the most part, we're not telling people in 90 days, you better write a big fat check for, $15,000 for 4 mortgage payments that you missed. It's more or less pushing that cash or those payments to the very end of the amortization of the loan and tacking it on there. Also, your credit report is also not impacted. So I don't know if that has anything really relative to do with income taxes.
No. I just think it's like I said, when you do taxes, you get a lot of financial information about people, and people will ask me that question, and people will ask you tax questions, and we're always like, ask your tax advisor, ask your whoever.
Yeah. The rules change, right? They change so rapidly. And this year is going to be unique because of everything that's happening. So you say one thing today and it could totally be different by the fall.
Yeah. Yes. Yeah. Or you send out an email to 700 clients and the next day you're wrong.
Yeah.
Hilarious.
I agree on that one.
So great. Or you spend your Friday night reading a interim final rules by the U.S. Treasury, because that's what's cool to do.
Wow. I'm so sorry.
Anyway, I want to talk about a couple more things. I'm like not following my own outline related to taxable income. One thing is that with one of the new, I guess like COVID relief acts, that laws, regulations, rules that came out, is that if you need money because you are affected by COVID, so you got laid off, furloughed, got sick, a family member got sick, there's a new law that allows you to take money out of your retirement plan. Normally you can't do that until after you're 59 and a half. And so if a person needs that, they can take up to $100,000 for what they call coronavirus related distributions. And the new thing is that you have 3 years to either pay it back or to be taxed on it. So you can spread the tax over 3 years. And what you what's not happening is you're not being taxed, you're not getting a penalty of 10% for taking that money out of your retirement plan before you're 59 and a half. So I did want to mention that, but there are many reasons why you should not take money out of your retirement account. But of course, if you need to, that option is available to you this year, and to pay it back over 3 years is pretty great, or be taxed over 3 years. And then I wanted to mention one other thing. I knew I would get so excited and forget all the things I wanted to say, and then I would get excited about all the things I wanted to tell you. Okay, so what happens when people aren't paying their student loans, or they're not paying their mortgage? Right now, the student loans are in deferral. There is tax deductions for the interest paid on those items, on those loans. And your tax deduction is based on you actually paying those expenses. So you might have less mortgage interest or less student loan interest to report on your tax return next year because you actually paid less. So I did want to mention that because that's exciting to me. All right, then. So the next thing I want to talk about, so I'll talk a little bit about some tax stuff and go into Jennifer talking about some mortgage stuff, is the side hustle, or sometimes it's people's now primary hustle, of working for Postmates or Instacart, and what that means for you at the end of the year. You may be a person who has never done that before and doesn't really know what that is going to mean at the end of the year. I mean, I always do the pretty woman, which is like people come in with like their receipts and they're just like, help me. Or so when you work for Postmates, Instacart, TaskRabbit, you are not a W-2 employee. You will not get a W-2 at the end of the year. You will not have taxes taken out of the money that you earn. You will be considered self-employed. And that means that you are in charge of keeping track of how much income you made and keeping track of what your expenses are. And you'll report those at the end of the year, and you'll be taxed on that income, on that net income, which is gross income minus your expenses. And so that can get people in trouble if they are not making estimated payments of tax to pay those taxes. Self-employment tax is 15.3%. So that happens no matter what happens on your complete and total tax return. If you have $10,000 of self-employment income, you will pay $1,530 of approx of self-employment tax. And that can sometimes be a lot of money for people, especially when you only made $10,000.
Question about that, Kernel. Isn't it true that if you don't, and I could be completely wrong about this because it's not something I've done, but if you don't make $20,000 in total over the course of the year, don't you just not have taxable income? Is that crazy?
It is crazy.
Oh, okay, good.
I don't know where that money came, or that number came from. I like it. It's really if you have over $400 in if you have over $400 in income from carrying on a trade or business, and different CPAs or different tax preparers define trade or business differently. But basically, if you're doing something that is work, that you consider your work, that's self-employment. And if it's over $400, you have to report it. So whenever I hear something, a number like that, I always think like, what are they referring to exactly?
I'll find it eventually. My other question though is when you're self-employed, and specifically to talking about Postmates and Instacart and such, people can write off all of their gas mileage, and mileage for cars is actually pretty high right now, right?
Yeah, it is. In fact, I think it's 58 cents a mile.
Yeah.
Well, some people, when they do things like caviar, driving for all those, they don't really have any expenses, right? But you do have expenses because you're just driving. And so most people take the mileage rate, which really does add up. So you want to keep track of your miles. I know I've had clients that drive for Uber and Lyft, and the app actually keeps track of the miles for them. And I don't know if it's the same for the other Instacart and Postmates. I don't know if they would keep track of your mileage, but keeping track of your mileage is probably the biggest record keeping that you would need to do if you're using your car to do all that kind of stuff. And then other business owners would keep track of supplies, and I'm trying to think what else these kind of side hustle things would have. Basically, keep track of it. Your phone, a percentage, you get to take a percentage of your cell phone. Kind of keep track of things that you think you're using for business. Lots of people talk about a home office. Catherine, you've probably had a home office in your past. I know you have a home pantry office now, but you're also an employee, so you can't do anything with that. But a home office really only works if you have a reason to be using a space in your house to be working. If you're driving Postmates, Uber, Lyft, you don't really have a need for a home office to do record keeping and things like that. So yeah, my main thing in that, obviously there are thousands of pages of tax laws about self-employment. But my main thing is, if you're doing it, realize that you will need to pay those taxes. You will need to pay that self-employment tax, and you pay income tax also. Income tax is just the normal tax that you're used to paying on your wages and investment income. You will also pay a self-employment tax to the IRS only, and that can really add up. And keeping track and trying to figure out if you need to pay any estimated payments of tax to the IRS in Oregon during the year is really important. And so this is where I wanted Jennifer then to talk about, so she and I had done a presentation on what your tax return should look like if you're self-employed and you're trying to buy a house. And I know that some people, right now it's hard. You might have had a job that you don't have a W-2 job, and so your employment is looking different. And so just want to have Jennifer talk a little bit about that, because I have friends who've been talking about wanting to buy houses, and RCR has a lot of people kind of in that demographic of where they're really starting to think of it, especially if you're stuck in an apartment for the last 2 months, you don't have a yard. So go ahead.
Kernel, but Jennifer had a great question about writing off a ticket. So Jennifer, if you want to feed that one.
Sorry, I'm just being ornery. It's late. Can you write off a ticket if you're on your cell phone while you're driving for Uber?
No, because penalties paid to the government are never a deduction.
Boo. Okay.
Why would you do that? It's obviously illegal and unsafe.
All right, well, I'll lead in. Thanks everybody for attending. Mine's actually a very easy part of the presentation. Just really simple explanation on, you know, if you're thinking about buying a house, what exactly do lenders look for in terms of what income's used to qualify for a mortgage payment? And especially with self-employment, there's so many ways to expense your tax return out. So oftentimes when I get tax returns, they're super skinny on what we use for income to qualify. So the class that Carrie and I taught was really relative to how to make the tax return bolstered up in income so that you can actually buy a house. So a couple of things I'm going to just talk about super brief is just post-COVID. I just posted a video on Instagram, and it was just a minute-long video about, okay, we were gainfully employed in January and February, and then the rug got pulled out from a lot of people, and now we're furloughed or we're unemployed, or, you know, our business has been shut down. So what happens post-COVID? I want to buy a house, and, you know, what are you going to look for? Because there's obviously a gap in income and there's a gap in employment, right? Because we've all been kind of sidelined. I finally did get some directive, which is part of this video, on what to expect. If you still have this in your game plan to buy, you still can buy a house. There's just a couple of extra pieces of layers that we have to get, because now we're going to be dealing with post-COVID eventually, I hope. And that's really when people go back to work. And anybody who's salaried, the rule of thumb is, as long as you have your first pay stub and it's pre-COVID restored earnings. So we're looking at one pay stub, we're verifying what it was prior to the furlough or layoff, and then we're going to check it to see what the income is afterwards. So that's super easy for salaried employees. Hourly employees are a little trickier. A lot of my clients right now had full-time gigs, but they're getting restored part-time coming back into the fold. And that is definitely a trickier situation, because you want to verify your previous earnings, and going back to part-time is less income. So what every lender is going to come out and say to you is, hey, your hourly, we need to know what your hourly rate's going to be. So we need 2 pay stubs. Again, it's always verifying what was pre-COVID, and then what's going to be post-COVID would be with the pay stubs you supply. Tax returns are going to be a little bit more trickier, because a lot of businesses that were shut down, massage therapists, I mean, you know, yoga instructor, hairstylist, all those businesses basically shut their doors and couldn't see anybody. And that's trickier in the sense of, not only is it going to take somebody who's self-employed to slowly reopen, because it's based on the phase in the county and what you can do. And then the second piece is showing stability of income coming back in the door. So again, that's part of the video that I posted, but really what we're going to be looking for is what income has been coming in the door, maybe even during COVID, because I've got a lot of people who've done online sales too. So they did still be able to generate income even though they weren't physically seeing clients. So the bank's going to be looking for bank statements from the business account to show what deposits are coming in. Now, what information we're going to use off those bank statements are a comparison to your 2019 tax return. So what they're really just wanting to make sure is that when you get your business back up and running and income's coming in the door, we want to make sure we're not putting people into loans that aren't quite ready to get there yet. And I'm assuming most self-employed people will be very cautious anyways before they dip their toe with a mortgage, just to make sure they've got enough income coming in the door that they're not going to be, you know, without the ability to make a mortgage payment. So for tax returns, so that's post-COVID. So that's going to be a slower transition for self-employment. That's post-COVID direction if you're still planning on buying a house. Now, let's say nothing has been sidelined for you and you've been self-employed and everything's good to go. Tax returns, depending on what type of taxes you file, so most people are sole proprietors or they're S-corps, we're really looking for 2 things. Net income. So for a sole proprietor, you have your gross income, you expense, and then you've got your net income. Every lender is going to only look at the net income. They don't care about your gross receipts, other than they want to show that it's growing from year to year. So when I have self-employed clients come to me with their tax returns, the first thing we're having a discussion about is, what can you do to stop expensing so many things so that we can get that net income to look a little bit healthier. That's kind of just a simple conversation with a lender such as myself. I do a lot of reviews for self-employed tax returns around February of every year, where I'm getting draft copies of tax returns before they hit the button to the IRS to submit it. And it's really a conversation of, okay, I need this much income if you want to buy a house for $400,000. Okay, how do we get it from point A to point B to get that much income to go? And that's another conversation with your accountant. So there's a lot of different things. I've got a lot of accountants who will bury some things in the tax returns, and we have to kind of find it like a little, it's almost like a little challenge for lenders sometimes. No offense, Carrie. But for the most part, it's just looking for, yeah, just looking for stability of income and a 2-year history of it. So if there's any if there's any questions you have in the Q&A, please throw them in there. I'm always happy to answer them. But that's kind of what I have as a short and skinny presentation without it getting too layered and thick with too much detail about tax returns. But for the most part, Umpqua Bank's still lending, still do a lot of loans for self-employed people. It's not a scary thing. But what I always tell my business clients is, if your tax return's too skinny on income, we need to just make a plan to make that a little bit healthier, that by the time of next year when you're ready to buy, we can take a look at that and see where we can do some tweaking to get you in a house. That's the whole point. So that's my presentation. I've been in lending forever and a day, 4 recessions. I know I look like a baby, but I'm old as salt. But anyways, I've been doing this.
Yeah. That's what I thought too, when I kept remembering all the different tax things that had happened, and I was like, I remember that credit. I remember that.
Yeah, and it's not a scary adventure to buy a house if you're self-employed. It's just really, honestly, it's about picking up the phone and just having a conversation about what it is you can do with your budget. So that takes about a whopping 20-25 minutes on the phone. So it's super easy. And you've got my link in the presentation. So if you ever have any questions, just feel free to email me with what you got, and we'll answer them.
Yeah, so unfortunately, lowering your taxes and increasing your income for getting, lending purposes are oppositional goals. So, at the very most, it sounds like if you need to increase your income, it's for a couple years. And then you can go back to whatever shenanigans if you need to write off your lingerie and your lattes daily, which are not allowed, but believe me, my clients try. Okay, that's awesome. Yeah, I think that when Jennifer and I did this presentation, definitely it opened some eyes to the people who were at that presentation of like, oh, like, should I amend my returns? I wasn't really, and we did, I talked to a couple people about that. Yeah, if you think that you had something on there that maybe wasn't correct, or, you're not sure, have someone, a CPA, look at it, and have your mortgage person look at it and kind of tell you if there's some opportunities in there to do something different.
Do you mind, can I just add one more thing to it?
Yeah.
Okay, so let's say you come to me and your 2019 tax returns are skinny, and I'm like, hey, we need to change A, B, and C. Can we get more income? Your accountant says, yeah, you can do that. Here's what it looks like, but here's your tax bill now that you've done that, which is what most self-employed people don't want to hear. From a lending standpoint, we can use tax payment plans as long as you have a letter from the IRS stating the duration of the plan and the payments. And we can actually put that into your debt qualifying. So I've had some self-employed people where they're like, okay, I've done what you've said. You said I can be approved, but now I've got this huge tax bill. And so what we end up doing is getting a letter from the IRS saying your payment's $150, and then we include that in the qualifying. So that can be a strategy, but just keep in mind it's a debt to the IRS, right? So it's not like it's going to go away. But for the most part, some people will kind of do these shift pivoting with their tax returns, and then the next year they just
pivoting, shifting,
pivoting.
Okay.
Not shitting, just pivoting. Well, maybe, I don't know. It depends on the tax. But yeah, there's some things you can do that aren't a long-term picture. They're a short-term plan to get you from point A to point B, which is keys to a house.
Right.
Yeah.
And you had mentioned before it kind of is unfortunate. I mean, like you can do an installment, but yeah, the money that you might have saved for your down payment is now going to pay those additional taxes to get your tax return where it needs to go. So it's just ends up sort of being like this.
Yeah, it's no,
And it's all a crazy equation because mortgage rates are so low. So you're getting this money
exactly.
at a rate you never would. It just,
Yeah,
it can be mind boggling when you think through all of the different aspects of it. But
yeah, yeah. And then I have some friends who just bought a house. Shout out to Fleet and Bella. And we're saying, well, what do we do? How do I do our taxes next year? And the thing that the important piece of paper that you want to keep after you've purchased a home is called a Hud Settlement Statement or a closing statement. It gets mailed to you typically or emailed after the closing of the house. And that document actually has important information that your accountant can use on your tax return. So once you go to do your taxes after you've purchased a house, make sure you have that closing statement or that settlement statement to get some extra deductions that might be on that statement when you do your taxes. Cool. Okay. Then that's a great segue. My next segue is into a question I get a lot from people. There's a lot of people hear the words itemized deductions, and you talk about itemizing, and they don't really know what that means. And so I wanted to go over that. Only because it's a common question and it actually has to do with buying a house. So people will come to me and ask, should I itemize? And whether you itemize or not isn't actually a should. It's an opportunity, and you're either taking an opportunity to itemize or you're taking an opportunity to use the standard deduction. And the standard deduction is a flat amount that the IRS has set that is an amount that you're able to deduct from your gross income, which is all of your income added together, minus some other things, is called your adjusted gross income. And then you can subtract from that either a standard deduction, which if you're single is $12,200. If you're married, it's twice that. And so you can deduct that standard deduction from your income, and that becomes your taxable income, and that's the income that your tax is calculated on. Now, the reason that many people don't itemize used to be before tax reform is because they didn't own a house. So when you buy a house, you get two major deductions that really affect your tax return. One is your mortgage interest, which the first few years that you buy a house will be quite large. Most of your payments are interest in the first few years after you buy a house. And the second deduction that you get is your property taxes. So everyone pays property taxes. Usually you pay it as part of your mortgage payment. Those two deductions added to your some other items, state taxes, charitable contributions, are what makes a larger amount usually than the standard deduction. The standard deduction before tax reform for a single person, I think, was about $6,000. So they really increased it with tax reform, and they made it so many people no longer, so mostly married people, no longer itemize. So it's not because you're allowed to take the larger of the two. So you take either the standard deduction or your itemized deductions. You take the larger of the two. If you don't own a home and if you don't own a home, you don't have mortgage interest and you don't have taxes, your itemized deductions are not going to be more than the standard deduction unless you are a very generous charitable contributor. So it's not a should I, it's a here's all my stuff, can I? Can I itemize, or do I just take the standard deduction? And with the standard deduction being so big right now, like I said, 12,000 or 24,400 for a married couple or a couple filing jointly, most people, I own a house, I don't itemize any longer because that standard deduction is more. So that's not really an exciting piece of information. It's just something that I get asked a lot. And so I just wanted to answer it.
It's so curious that they raised it so high so suddenly. To me, I was shocked by all of that. I guess they felt the time wasted with all the itemizations was.
Yeah, it was big. It was so big for so many people. I mean, you have a kid.
Yeah.
The standard deduction plus the child tax credit.
Yeah.
Jennifer, you have a kid too. Like, it's just like, it was, yeah, three. You have 3 deductions, credits. Yeah. Yeah, it was amazing for very many people. It was
very
amazing.
baffling.
It, you know, no surprise to anyone. It also helped very rich people who also had kids and were in AMT, which is another thing completely I'm never going to talk about again. Anyway, so yeah, so one thing people always ask, let me see if this is my next slide, is should I keep my receipts? Or they'll tell me, oh, I have some receipts for my charitable contributions. So charitable contributions, for the most part, are really only useful when you itemize. So for most people, you don't really need to keep those receipts from your charitable contributions because you're not going to be itemizing. Now there's a whole other thing I'm not talking about, which is a lot of people who own homes are taking the standard deduction for federal and itemizing for Oregon. It's a whole big thing. For the most part, if you don't own a home, you're taking the standard deduction, the charitable is receipts and the charitable deduction is not going to affect you. However, as part of the CARES Act, as part of COVID relief, we are now able to deduct $300 for a single person and $600 for married filing jointly on our tax returns. Everyone can do this unless you itemize. It says regardless of whether you itemize or take the standard deduction, but I read some more and that's actually not true. If you itemize, you're just adding it to the things that you're already itemizing. So this is like, I think Rocket Me actually sent out an email about this, that I think can consider your dues to RCR no longer dues, but a charitable contribution, because I don't want to get into this, but I think that was the thinking, is that a lot of people who normally don't get any benefit from making charitable donations can now get that benefit for making extra charitable contributions. And so I think that that's pretty awesome. During the tsunami, I think there was like a $25 thing that people could get or something. Another thing that came flooding back to me as I was making this presentation. So just keep that in mind, everyone. There are so many things, obviously, to contribute to. And, we're all able to take advantage of this. So please keep that in mind. Okay. So the next thing I wanted to talk about, well, you know what? My next topic is kind of specific, and it's 6:43. Catherine, do you think that we should take questions, or there just aren't any questions? So
I think you're just being so clear that there aren't any questions and you should keep going.
For the hundreds of people who are watching and mesmerized by this information.
Well, there are 10 of us now, so.
I lost 4 people.
Oh, no, we're 13 total. With the 3 of us.
Okay. Anyway, so the last couple of things I wanted to talk about, and actually Jennifer and I ended up talking about this too, was renting. So a couple things, renting a room in your house, but also what happens if you want to buy a house and you're going to have roommates? Well, I already asked Jennifer and she said it doesn't really matter. If the people are not on your loan or they're not, part of your loan application, any roommate income that you might get does not help you with that loan. Even if that you're always going to live with these 3 people, but they don't have the income or the whatever to be on the loan, or you don't want to own it with them. But one thing we kind of talked about is Airbnb or just renting a room. And what does that mean for your taxes? And I'm not going to go into that too much. What I do want to say is that if you do own a house, you can consider maybe just cost sharing as a way to think of the income that you get from those roommates, which is, it's just people who are helping you with your mortgage and your taxes, and they're just kind of helping you with those expenses. So that's one tactic that CPAs take. But when a person is actually doing an Airbnb, we actually do report that as rental income on a tax return. And it's similar to if you owned a house and rented out the entire house to someone. You can actually consider Airbnb income if you're just renting a room as income, and report that, which is good and bad, right? Any income you report, you pay taxes on. But in my talks with Jennifer, she said if you want to refinance or your loan, having that income on your tax return will be helpful. So Jasmine just texted me, and I maybe got the intent of one of her slides wrong. But anyway, if anyone has questions about Airbnbs or rentals, it's a difficult, there's a lot to it. And so
changing the rules.
Yeah, I mean, people do it different ways. People used to do it. Yeah, it's a lot. But just know that if you are renting a room on Airbnb, you are supposed to report that income, and there's, taxes to be paid. And obviously if you're renting out a whole house or whatnot, that's a whole nother thing also.
Yeah, if you're renting out on Airbnb at this point and you're not reporting it, start renting out on Craigslist or Vacation by Owner, because Airbnb is reporting it for you.
Oh, they're doing a 1099.
Mm-hmm.
Yeah, I had heard that some of them aren't doing it until you get to a certain amount of gross receipts. So I wasn't sure about that.
Huh, that may be the case.
Yeah. Oh, and there is one thing that's nice about renting. You can actually make cash from doing an Airbnb, but have it come out as a loss on your tax return. And my suggestion to people, when they get into situations, when you're doing a side hustle, when you're starting your own business, when you're maybe renting Airbnb, is not to get afraid, not to be afraid by all the things that now may be happening on your tax return. I have seen too many clients and friends get so overwhelmed by a thing that might be happening, and we don't know that they don't do their returns. And then when I talk to them 3 years later, and it's actually too late to file and get a refund, and I say, oh, you had a loss in your business, you could have just reported that, and then you actually would have lowered your income and you would have gotten a bigger refund. And they're like, oh, I didn't know. So anytime you have stuff like this that seems out of the ordinary, find a tax professional to ask, because it may actually wind up to be beneficial for you. The thing that you think might make you have tax might actually result in lower tax. People ask me a lot about inheritances. Inheritances are not taxed. That's a blanket statement. There is some tax involved. But it's always good to ask someone and to not be overwhelmed by everything that you think is out there. Because someone like me can explain it to you and only slightly look down at you when I'm doing so.
I have a basic question. As someone who never would have thought to consult a CPA until I went into business for myself, but was always doing side hustling and should have done it way sooner. Can you just tell people what your hourly fee is?
Oh, mine?
Or what a general one is.
Yeah. I'm pretty cheap. It's not going to sound inexpensive, but my personal rate is $175. Other people in my office have a lower rate. Someone like Jasmine might have an even lower rate. Sometimes we get paid in cookies. Sometimes we get paid in, so my rate's $175. So if someone needed a consult, someone coming off the street, I would charge them that rate for like an hour's worth of time.
I definitely was upset when I realized how many years I could have done better with the way that I was shenaniganing around with all my various jobs and things and owning my business before I got a CPA to help me.
Yeah, and I think it's surprisingly affordable. I mean, like you said, based on what you have and all of the pain that it takes off of your plate and puts onto mine, which is not get paid. But I like my job. Yeah, okay, the one last thing I'm going to answer, because people do ask it a lot, and I see a lot of misconceptions about becoming an LLC. People think this is some magical business structure which will do magical things to either your taxes or your income or your who knows what. An LLC is a state designation that is for liability protection only. And so you could put property into an LLC, you can run a business out of an LLC, and all it means is that, I mean, this is a simplification. All it means is that if I own a rental house and I put it into an LLC and someone trips on the sidewalk and says, oh, I see you own this rental house as well as your personal residence and that car and that business, and I'd like money from all of those things, please. If my rental house is in that LLC or my business, the way that that entity works is it's for liability protection so that a person cannot sue me for everything I own. It does not have anything to do with how you're taxed. And in fact, when someone tells me they're an LLC, it still does not answer me the question of how are you taxed? So that's my answer for LLC. You could tell after an hour, now I've gotten to the things that really grind my gears. But if you want to be an LLC, that's your choice. It does not have anything to do with being taxed. And you can also, some people believe you can accomplish the exact same things with insurance as you can with an LLC. So that's a question for an attorney or an accountant. And that's all I have.
I have a quick question on that. If you're an LLC and you own a property specifically, since that's the scenario that you gave as an example, you would also want to make sure that your insurance, if it's a rental property, that's, even if it's on your property, because I remember looking into that with having my Airbnb is the second story of my duplex, and it's in an LLC, but I need to make sure that my homeowner's insurance knows that and is writing a separate policy through the LLC, which I didn't do the first year. So if there had been an incident, whoops.
Yeah. Also, you often cannot get, if you have a loan, you often, maybe not often, you may not be able to put that property in the name of the LLC. Yeah.
Yep. That's true.
Yeah.
Yep.
You may need to use insurance.
Are business entities, and that's a business loan, which is totally different than residential. I get that question weekly, all the time.
Yeah. Also, do not create an LLC with your partner, your spouse, your partner, your kids. Don't put them all into an LLC thinking that you're creating some great will or estate planning vehicle, because what you've now done is created a partnership, which results in me having to prepare a whole separate return for you, which is going to be a minimum of $500 to $2,000 to prepare. So don't just go and do these things without, yes, talk to a lawyer. Smush is like, make sure to observe corporate formalities for liability protection. Talk to a lawyer. Yeah. They're very all the rage right now, as well as S corps, and they have very specific uses and very specific meanings. And so just best to ask good questions before you do that kind of stuff.
And I'm just going to add one more thing. Also check in with the state, because even if you have something under an LLC, it doesn't necessarily protect you even legally. A lot of states are kind of shying away from LLC designations so that people will stop hiding behind it. So you got to check your state rules. They don't always apply. LLC doesn't mean complete protection if somebody trips on your property.
Yeah.
Does anybody have any more questions for these two lovely people? I could talk forever about this stuff. So I have like 6 more questions, but at the risk of sidelining the conversation to a personal Catherine conversation, I will hold them back until I pay for further advice. But anybody else have more questions to put into the chat or the Q&A? I think no. I think this was very helpful information. I loved this. I would love to put a copy of the presentation in the YouTube. We're finding these are living on YouTube very robustly, actually, more than I would have expected. So we're getting a lot of clicks on these and people being able to follow through on the slideshow and know, oh, I want to look at this section and it's this minute. I'm going to go ahead and take your slideshow and put somewhat, of the mile markers on it so that people can jump to the section they're interested in. I think that'll be helpful for people.
You sound very proficient.
Oh, yes. I'm getting so good at not using duct tape every day.
No more clipboarding for you.
All tech all the time now. Yeah.
Thanks for having me. I really enjoyed being on here, and I'm always available for questions. Easy to find.
Yep. And your first, am I wrong in that your first little bit of advice is actually free advice when people are looking to purchase a home? Yes, that's a thing through when you work.
Yeah, although I might charge Carrie's hourly rate.
It's a good idea.
Or at least just bring a cookie for me. I'm good. I'm easy.
Yeah.
All right, y'all. Thanks so much for your time. This was awesome, and I can't wait to post it to the YouTube.
Bye, guys.
Bye.
See you later.
Have a great night, everybody.
All right.